Finally, a smooth week.
A little too smooth, don't you think? It's such a nice trading week, and we hate to bring some warnings.
We really do, but we have to let everyone know when we see it, unfortunately.
We will go over some data from FINRA and talk about Jeff Bezos' recent stand on Biden's corporate tax plan.
And everyone who works in tech, manufacturing, or know people in those fields know about the chip shortage. So we will talk about some investing logic behind TSM or Intel.
Looking at the recent report from FINRA, on the margin debt balance, we have reached the highest since 2018, and the year-over-year increase of 49%, which is also the highest since 2007. For those who don't know, FINRA is an organization that oversees and regulates exchange markets and brokerage firms.
This is crazy. Investors borrowed a record 813.6 billion against their investment portfolios.
What does that mean?
The surge in margin debt indicates that investors are chasing bigger gains and exposing themselves to riskier plays.
And for the borrowed money, brokerage firms have set margin requirements.
That means your assets and cash needs to cover the minimum requirement for your margin. So if your margin plays didn't go in your favor, and your assets will be forced to sell by your broker, which you know what happens to the market when a lot of accounts get margin called as a correction happens.
It will trigger a strong downward momentum.
So here's a couple things I want to note. First, this data is from February, and March data is not available yet. And since there was a small correction in February, a lot of accounts might have gotten margin called, and that will reduce the total margin debt. And second, this is not a bearish indicator. Just because margin debt is high, it doesn't necessarily mean that the market is peaking.
We just want you to be aware of the risks associated with the high margin. And we are currently at the highest for over the past 20 years and the fastest growth rate since 2007. So we need to pay attention to how the market goes later on with this number.
So what should we do with our positions?
I think it depends on the individual stocks too. If your company has real revenue supporting the stock price, I think you are relatively safe.
But if your holding is still not profitable or has no clear guidance, you should probably consider taking some profit and reduce some exposure or holding.
I agree with that. Let's take a look at the market.
Nasdaq took over the lead in April and now testing the prior all-time high at 13,870.
Tech has been so strong lately, and the S&P closed the week at an all-time high at 4,128.
This run-up is quite impressive, but yet it went up too much and too fast.
I'm pretty amazed too, which worries me. Nasdaq is gapping up almost every other day, supported with little volume, and we are really overbought right now.
I don't think there's a lot of room on the upside in the short term, and we will likely see some pullback or sideways consolidation.
I have initiated some hedge positions for the upcoming weeks to protect my open positions from any unfavorable downward moment.
That's good. Better play safe than sorry. Nasdaq is testing a significant resistance level at 13,870. If the bull can't claim this level, expect the price to retrace back to the first support at 13,650. And if this level can't hold, expect Nasdaq to go down to fill the gap between 13,350 to 13,400.
And for the S&P, be aware of the first support around 4,060 to 4,070, and the second support around 4,020 and 4,030. Besides the support, not much more to talk about here.
We are expecting the market to pull back because of Nasdaq and S&P. We're not saying to clean house, but booking some profit would not be a terrible idea with the margin debt rate surging.
Yes, definitely. But you know what's not surging?
Jeff Bezos' taxes.
That's right. Did you hear the world's richest person, Jeff Bezos, supports Biden's corporate tax hike?
Yeah, which is something I don't understand. Big businesses generally aren't excited about higher taxes. So it's no surprise that many other American corporations are fighting against Biden's infrastructure plan.
Yeah, it's definitely puzzling. So apparently Amazon didn't pay taxes for 2 years until 2019. And from 2018 to 2020, Amazon paid an average of only 4.3% effective federal income tax.
Wow. So my guess is that since they've been paying essentially nothing, Jeff probably thinks this is a good PR for the company. And what's the harm to pay a little premium for good PR when it didn't pay taxes for a while.
Absolutely, and probably because Amazon is currently under scrutiny for mistreating their workers, such as inadequate sick leave and not allocating enough time for breaks.
Aside from that, Jeff Bezos is very confident in his accounting team, which has been helping him save billions of dollars in the recent tax years.
Yup, so if we use the 21% corporate tax rate for 2020, Amazon actually saved $2.3 billion in income tax. That's well over 50% in write-off.
Wow, that's ridiculous. Anyway, in a March news release, Intel CEO said they are expanding their manufacturing capability starting with 20 billion investment to build new fabs in Arizona.
And also announced Intel Foundry service with plan on becoming a major foundry capacity provider.
Does that mean it's a buy for Intel?
Hmm, let's compare Intel and TSM. Since they are both chip manufacturer, can you briefly explain the types of semi companies before we analyze Intel?
Yeah, for semi companies, there are three main types, which are integrated design manufacturers or IDMs. They design and manufacture their chips. Second type is fabless semi companies or design house like AMD and Nvidia. And third one is foundry, which are pure play manufacturers like TSM.
And basically, if a design house or foundry is able to design or produce a smaller nanometer chips, that means the company is more technologically advanced.
Exactly. TSM has 7 nanometer volume production capability since Q2 2018 and achieved 5 nanometer volume production in 2020. Your iPhone 12's A14 chip is actually made by TSM's 5 nanometer process, and so are chips in your M1 Max.
TSM also released the detail of their 3 nanometer process in August of 2020, while Intel is currently struggling with its 7 nanometer technology. And the 7 nanometer won't be available for volume production until 2023.
2023, TSM will be volume producing 3 nanometer chips in 2022 already. Intel is so behind. Why would design houses like Apple, Nvidia, or AMD give their 5 nanometer and 3 nanometer chip designs to Intel to fab when Intel doesn't have the capability to?
Not only that, since Intel is an IDM, which is mean they are designing chips themselves, unlike TSM, which is a peer foundry, why would competitor hand over their design to help their competitions?
That's really
I agree. It's okay if Intel has an industry leading nanometer process, then maybe design houses will be willing to give their orders to Intel to fab, since that way companies won't have to worry about their tech being stolen.
Yup, so long story short, we are more bullish on TSM just from a pure technological standpoint.
Not to mention, TSM is building a plant in Arizona too, which will increase its brand exposure to US investors.
We will be loading up TSM on dips, as we have been saying and doing for weeks. It's time for top picks of the week.
Yup, and my first pick of the week is QS. I'm buying shares on less than $40 a share. Be careful on this as the company is still in R&D phase and no sales. My plan is to unload between $60 to $70 and stop loss at around 37.
My first pick of the week is Biotech ETF XBI. It is currently sitting at a nice support level. For all new position, I will set a stop loss slightly below $126.
My next pick is FCEL. I'm opening a small position between $10 to $11.
Nice entry for BTWN. My average is around $11, and I would add more if the price retest the support area around $10 to $10.30.